everyone, my name is P. DIVYA, Assistant Professor, Department of Commerce, FMA, KSRCASW College of Arts and Science for Women. In this PPT, we are going to see what is a cost of capital, definition important, computation of cost of capital, EBIT, EPS analysis, leverages, a capital structure theory, a dividend theories, and the conclusion. First, we are going to see what is a cost of capital. A definition, a cost of capital is the minimum return required by the investor to fund a project or the investment. The importance of cost of capital helps in evaluating the new project, determine the hurdle rate for the decision making, and it affects the company's valuation and financial performance. The components of cost of capital is interest bearing instrument like loans or bonds, equity, a fund raised from shareholders, preference capital, hybrid instruments with a fixed returns. Next one is we are going to see what is a computation of cost of capital. First one is cost of debt. So measure the after tax cost of borrowings. Explanation, I represent the interest and T represent the tax rate. A cost of equity, it reflects the return shareholders expected. The cost of preference shares and fixed return for preference shareholders, and then combines the cost of all the sources weighted by the proposition of the capital. And we are going to see EBIT and EPC analysis. EBIT means earning before interest and tax, and the earning per shares. So it helps in determining the best financing option by analyzing the impact of earning before the interest and the tax on earning per share. And debt financing, it leverages the borrowed fund but increasing the financial risk. Equity financing, it dilutes the ownership but avoids the fixed cost of debt. And it is a EBT where EBS from debt equal to EBS from equity. It aids in deciding the optimal mix of financing. And what is a leverage? A leverage is indicate the extent to which a company fixed cost to magnify the returns. A type of leverage, first one is operating leverage. It arises from fixed operational cost, and high leverage equal to high sensitive to sales changes. Financial leverage, it involves the fixed financing cost, example interest. Next one is increases shareholders, it returns but also the risk. Capital structure theory, it examines the impact of debt and the equity mix on the firm's value. The first one is net income approach. It suggests the value increases with the higher debt due to lower cost. Net operating income approach assumes the capital structure relevant to the value. Next one is a traditional approach. It advocates an optimal capital structure for maximizing the value. Next one is approach. In perfect market, capital structure does not affect the value except under the tax consideration. Next, we are going to see what is a dividend policy. A dividend policy is nothing but a company's strategy for distributing the profit to the shareholder. The type of dividend policy, first one is a stable dividend policy, constant payout regardless of the profits, constant dividend payout ratio, dividends are fixed percentage of returning. And then residential dividend policy, dividends are paid after meeting all the investment needs. The importance are balance the shareholders expectations and reinvestment the needs. The dividend policy and the shares valuations importance influences investor perception and the share price stability and determines the retained earning for future growth. Example of CAPM is assume the dividend, reduce the risk perception, positive dividend policy attracts the long-term investors. Dividend theory, first one is Walter's theory. It focuses on retained earning versus payout. For example, R is greater than KE, reinvestment, otherwise pay dividend. Jordan model assume the dividends are relevant to the valuation. Example, like a high growth firm should retain the earnings. Model, so dividend relevance theory, and assume the perfect market with no taxes or transaction cost, suggest payout doesn't affect the firm's value. And main takeaway in conclusion, so understanding the cost of capital aids in evaluating the financial investment and the decision, and leverage impact both the risk and return dynamic. Dividend policy and theories or internal value of shareholders.